Hello everybody, welcome to the Technical Analysis webinar with AvaTrade. My name is Troy. I'll be leading the session. As we get going, keep in mind a couple things. One is that obviously each and every trade you take has risk to it. There's no guarantee that any one individual trade is going to profit. I think we all understand that. So you want to manage your risk in a way that makes sense using trade sizes that present the right amount of exposure that you're comfortable with. You may use stop loss settings. You might use a special tool that we have at AvaTrade called AvaProtect also to manage risk. We'll go over AvaProtect a little bit later to show how that works. But in some way, you should manage risk so that you know what you're getting yourself into, so to speak, as you enter into a trade. Now, the other side of that is each and every trade does have a good potential for profit. And so that's the side that we're focused on here in terms of looking for strategies and information that can help hopefully improve upon your win percentage and your profit margins at the end of the day, end of the week, etc. So from an educational perspective, not to be taken as financial advisement, but from an educational perspective, we'll go over some ideas that I've found helpful and that others have found helpful with putting together concepts for trading strategies. So in general, let's talk about what is technical analysis. We'll just briefly go over these general ideas, and then we'll get on the live charts and look for some potential entry points and exit points for trade opportunities. So technical analysis is basically just looking back at the charts. And when we talk about charts, usually we're talking about candlestick charts that when we look at them, we can find patterns that may indicate price levels or movements that are repetitive or predictive in nature, so that at certain points you'd say that's a good spot maybe to buy or to sell. And the same idea for exit points from trades. You can find locations that might be a likely spot where a reversal might occur, and maybe it's a good spot to get out or maybe take partial profit, etc. And so this is what technical analysis does for us. The movements, when we look at the technical analysis, really have the fundamental analysis built in, meaning when you see price levels that held for some time and then broke through on the candlesticks, that usually aligns with a large fundamental news story that occurred at that time. And so the fundamental news, the fundamental information is built into what we see on the candlestick charts. And so it's interesting when you take a quick look at the fundamentals before you do your technical analysis, you might be able to predict a little bit better what might come with the technicals as you're planning entry points and exit points. So we'll do that today. We'll go through that method of quickly looking at fundamental analysis and then getting into the technical analysis for specifics in terms of entry points and exit points on different instruments. So far, I've been speaking about manual methods of technical analysis, looking at the chart, finding price levels that look like opportunistic entry points and exit points. You also can use indicators that help you with that. Indicators aren't as smart as you, meaning the indicator can only look at the candles and look back the period that it's programmed to look back and tell you based on its programming whether maybe it's a good time to buy or sell. That's what the indicator does. The same as you look at the candles, the indicator's looking at it and giving you either a pictorial representation, usually like the RSI or the stochastic indicator or Bollinger Bands. There's some sort of pictorial representation and signal that you see as to when to buy or sell. And so all those indicators are doing, and there are literally hundreds and hundreds of them, are looking back at the statistical analysis of the candlesticks, the same as you can see with your eyes, and telling you when it thinks maybe there could be a reversal or a breakthrough movement. And so if you combine that with the fundamentals, then now you can selectively pick which indicator signals you trust and which ones you don't, because the indicator is not smart enough to look at the headlines and know what happened yesterday in the US with the monetary policy statement and information that came out. The indicator is not smart enough to know that the European Central Bank and also the Bank of England have big announcements today. And so because you are smart enough to combine that information with the technical analysis, that's where the manual methods of technical analysis come in as well. And the indicators can be used as a reference maybe rather than a tell-all. It could be just part of your strategy. Okay, if you have any questions as we go along, please ask. If you have anything you want to give as input, also, please do so. I'm happy to share information as well as answer questions as we go along. So as we look at quickly, it only takes a minute to see what's on people's minds right now. What are the fundamentals before we do the technical analysis? And you can see the headlines, one after another. Fed patience calms yields for now. Okay, they're talking about the US Fed, who talked yesterday and the day before about monetary policy and their view of the health of the US economy. And so they actually came out and said that they think the economy is relatively strong and that there's going to be a rapid rebound, a strong rebound in the US economy. And so that calmed what they say, yields of the bonds for now. And when we talk about bond yields, basically they're talking about if people buy government bonds, otherwise called treasury notes, 10-year treasury notes, 2-year treasury notes, longer even time period treasury notes, basically those are guaranteed returns. And so people focus on, what's a better investment? Bonds with guaranteed returns that are typically less in terms of potential return, right, compared to the stock market, or if there's less fear on the markets, maybe people invest more in stocks, which are riskier but have a larger potential return, and don't invest in the bonds. So there's a seesaw effect back and forth. If bond yields get too high, they become more and more attractive, and that could spur a potential sell-off of the stock market at some point, especially if there are inflation fears. And so you combine what the Fed said yesterday, and in general, it calmed the yield curve, as they call it, when they compare like the 2-year treasury note return, the yield on that compared to the 10-year. And there's a certain curve that if it becomes too steep, if there's a big difference between the two of those, it's like a flashing red light that, hey, maybe a dash into the treasury notes at the higher yield could occur, and then maybe there's a sell-off on the market looming. So they're talking about the Fed patience yesterday, patience with keeping interest rates low, not raising the interest rates, and also being patient with their other tools that they've been using to prop up the economy. That calmed things a bit. But others in this article that are involved in the market quite a bit are saying it's like a coiled spring right now. Meaning, boy, if those yields get too high and the treasury yield curve then gets too steep, comparing the shorter treasury yields to the longer ones, that at some point could be so attractive for longer term investors to buy into the 10-year treasury notes that you could see like a coiled spring. You could see a quick and rapid response in the markets. And in this case, they're referring to a potential sell-off in the markets. Good question. Declan is asking, are bonds more subject to inflation than stocks? Okay, if there's a lot of money being handed out like it has recently, the U.S. just passed $2 trillion in stimulus. That tends to be inflationary in general, meaning you hand out free money and you keep interest rates artificially low. That tends to cause inflation, a weakening of the currency, right? And if there's a weakening of the currency, then you eventually can have fear of inflation, which could rise up gold, right? Gold could come up and eventually affect the bond market to where it becomes more attractive than staying in the stocks. So there's definitely a connection there with inflation fears, bond yields, and uh, risk of a potential sell-off in the market. And exactly how those correlate 100%, probably every expert will tell you something different. So I'm not about to sit here and tell you I can give you an exact formula of what to look for exactly. But in general, and a lot of times the KISS method, as an old football coach used to tell us as players, the KISS method usually works best. KISS meaning keep it simple, stupid. KISS. So if we keep it simple and don't complicate things too much, the idea is dramatically rising bond yields are sometimes a trigger to a sell-off in the market. Okay, bond yield curve too high, then prepare for potential sell-offs in stocks, in the equities, the indices, etc. That's a simplified version of it. If we start talking about inflation fears, certainly large stimulus can bring in fears of inflation, which can drive up gold. But inflation in that instance also drives up the market, right? The stock market will go up with free money, right? Free money is good for business usually. It drives the market up. But if there's competition to that free money, meaning, okay, stocks are going up great because of cheap money, because of inflation, right? Cheap money equals inflation, but it also equals business growth because the money's cheap. They can expand and hire, etc., at a lower cost. So as the stock market shoots up with a weakening currency because of a lot of stimulus, at some point, because the stock market's so attractive then with all this cheap money, the yields have to go up to attract people to bonds. So the yields go up, 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 and eventually the risk of staying in the stock market because it went up so far so fast becomes counterintuitive to stay with that if the bond yields are so high. And so if that yield curve gets too high, too steep, you could see a quick sell-off. That's the idea. So keep an eye on the bond yield curve, the yield rate of, let's say, the 10-year Treasury note, and at some point, you might deem that maybe it's time to get out of the stocks if they're went up so high so fast. Okay. All right, Declan. I can tell you're probably studying a bit because that was a good question. All right, so let's look at the headlines then. Fed patience calms yield curves for now. Okay. In general, if they're keeping the interest rates low and propping business up, that drives yields up because the stock market remains attractive. And for people to be interested in bonds, the yields are going to have to be higher. So it actually could drive yields up and create the problem that many are hoping doesn't occur, which is a potential rush out of the markets and into bonds. Okay. Stocks cheer dovish Fed. Okay. Same headline. It's in almost all the headlines right now. Stocks cheer dovish Fed as bond rumblings return. Okay. They're still rumbling about bonds. They're saying, listen, great. The Fed was a bit dovish in terms of saying they're not going to raise rates, etc. But there's still some concern about the exact relationship we talked about with bonds. There's another headline, a third one, steeper and higher. U.S. bond tantrum averted, but worries remain. It's a big deal, these bonds, okay? So it's not in each and every headline by accident. So you keep an eye on the bonds. If the yields start going to six-month, 1-year highs, etc., if you read that the bond yield curve is becoming more and more steep, you might think about taking a shot at shorting some stocks or some indices, etc. All right, so another headline, sterling rises versus euro ahead of Bank of England meeting. And so that's a big deal. And actually, I'll pull up the economic calendar. We've got the Bank of England talking later, okay? But right now, I take that back. Bank of England talking now, and let's look later in the day. We've got a large number of announcements. I'm sorry, so I was correct. The European Central Bank President Lagarde is speaking now, okay? And the Bank of England has their big speech and information coming in about 43 minutes, okay? Interest rate decision, meeting minutes, MPC member Haldane speaks a little bit later in the day, even further. So information and rate decision coming from Bank of England, European Central Bank President Lagarde speaking now. So if you talk about volatility on the Euro GBP, that'll be happening right now and through the rest of the day. Paul, we're just touching on that. Monetary policy information coming out of Great Britain later in less than an hour, and also right now live occurring for the European Union. Same sort of information coming out. So let's take a look then on the charts here in a moment. If we take a quick look at the option, if you wanted to use AvaProtect to protect against losses for defined time periods in terms of being part of your risk management plan, you can use AvaTrade Go, which is found here on our website, trading platforms, AvaTrade Go, and you can download it to your phone on our web trader, which you find by logging in here. It has the same features as AvaTrade Go, and so you'll see it's a very convenient to use platform, easy to search for instruments. And if I'm buying or selling on an instrument on this platform, you'll see that on gold, silver, and FX pairings, you'll see this gold shield, which means AvaProtect is available. You'll see if I'm putting a take profit, let's say I think gold will go up, not necessarily right now. It's just an example. We see it calculates your potential profit for you as you change your trade size, changes your potential profit immediately. So it's acting as a trade calculator as you're setting up your trade, so you're fully informed before you take a trade as to your risk and potential profit to those price levels. Maybe I think it won't drop below 1670. I put my stop loss there and I say, wow, I'm risking 641, 642. And I say, that's too much for me. I don't want to risk that much. So I lower my trade size, 5 ounces. And now I see immediately it adjusted my possible loss and possible profit. So before I buy or sell, I can be fully informed of my risk. I also have the option, instead of doing a stop loss, I could do AvaProtect. I could protect by the hour, by the day, and it gives me a premium cost for that protection, for that trade size, for that time period. Any losses during that time period are fully added back by the protection. Any profits are yours. So that's an option that you have for protecting against losses for defined time periods, which you'll only see through AvaTrade's web trader platform and AvaTrade Go. Okay. All right, so let's take a look then at the charts and see what's happening with the technical analysis with some instruments that are related to the fundamental news that we just saw. So this is an interesting setup. We've got the euro and gold following each other, right? Euro USD and gold, which is against the USD, today pushed back down. Okay, we see a steep drop. Why? Because the USD strengthened back today after yesterday's roller coaster ride with the FOMC statement. So we see USD strengthening back, pulling gold down, pulling the euro down. That's how we know it's USD related and not something just specific to one region. We see euro dropping, gold dropping against the USD. Now, an interesting setup when you're looking at this type of thing is if you then see one getting out of balance to the other, meaning I see over the last hour or so, the euro has climbed from down here up. So over the last 5, 10, 15, 20, 25, 30, 35, 40, 45, 50 minutes, right? The euro is gained against the USD. And we see the opposite, gold continues to drop against the USD. Now we know they were mirroring each other all along, right? So the question is, which one's telling the truth, and which one is behind? So which one's leading? They clearly are following each other, and we want to know then, does gold being down mean the euro is going to drop against the USD, or does the euro being up against the USD mean gold will go back up? And so you actually could take a shot at both. Now it's pretty volatile right now because we've got the European Central Bank talking right now. So there are some unpredictable movements. But I could envision a situation where I say, okay, I'm going to sell on the euro and I'm going to buy on gold. Where's my gold? Okay. I'm going to buy on gold and I'll put my stop loss for the euro below the support level here. Very limited risk, or I'm sorry, for gold below the support level, limited risk. My potential profit would be larger if I go to the resistance level up here. Okay, so resistance level, and I could look at a little higher resistance level if I want. We see on the candles resistance here, and then it dropped. So this is a short-term scalping technique. I'm looking at a relationship between two instruments. They tend to move together. Now I'm looking and seeing, wow, they've become divergent. They're not in the same direction anymore, but they tend to be in the bigger picture. So one of these needs to correct. One of them is leading and the other is probably going to follow. We don't know for sure which one's leading, but they tend to end up in the same direction in the end. So I've got a larger potential profit to this support level down here than I have to risk if it breaks the resistance here. And I've got a larger potential profit to the resistance level here than I risk if it breaks the support level down to here. So this is a technical analysis strategy that you can do with any instruments that tend to be related to each other. Gold and the Euro USD tend to be like that, and others as well. If we want to look for other instruments that have such relationships, we could talk about the Australian dollar related to the China 50. Why does the Australian dollar tend to move the same direction as the Australian 50, or I'm sorry, as the China 50, or any Chinese related instrument or index? Because Australia sells a lot of exports to China. So as China's economy goes, as their major indices go, many times so goes the Australian dollar. So it's interesting then to try and catch when those instruments become divergent to then trade for them to come back together in terms of their movements. Matthew, yeah, the word I think you're looking for is correlated. They're correlated together, okay? They have close trading ties, the Australians and the Chinese, exactly. So you would just need to, with your trade size in this type of setup, and I didn't take the time to measure the trade size and the potential profit and potential loss, but you would need to measure that the distance to my potential profit here gives me the same type of potential profit as the distance to my potential profit here. And the risk to my stop loss here is the same dollar amount risk to my stop loss here. Okay, so if you do that type of calculation and check, then all you need to do is come out on top on one of these. And if one's going the wrong way, the other's likely to go the right way. And you could have an overall profit being only right 50% of the time. Hamza, you're asking, does gold move in tandem with AUD USD? When USD strengthens, the Australian would fall, right? And so would gold typically. And if the USD weakens, the Australian tends to climb, and so would gold. So you could find a relationship there as well. Absolutely. Why am I looking at the Euro USD and gold? Because the Euro USD by far is the largest volume traded currency pairing, and typically has the tightest spreads, which then works in your favor as well. So, but certainly you could probably find some good correlation with AUD USD and gold. That's a decent suggestion as well. Okay, with all that said, let's take a look then at maybe crude oil. What's happening with crude oil? We've got on the 15-minute chart resistance here. Okay, resistance down, resistance down, resistance down, resistance trying to go down, right? Let's look at the bigger picture on oil. And we say this was an old support level. Why did oil come down a bit? What happened here to bring oil down? If you remember Iran, and we talked about it in the last webinar, Iran decided they're going to increase production of oil no matter what the OPEC plus nations have decided to do with not increasing production. Iran is like a thorn in their sides, saying, we don't care about the sanctions anymore. Trump's not around to punish us. We're going to skirt any sanctions. We're going to increase production, and they happen to find a buyer with China. And so they're discounting their oil prices, they're increasing production, selling to China, and the fears pulled oil prices down. And if we look at, say, the 4-hour candles, we see that drop in price in oil. Here was the high up around 68 on US crude, and then we see the large pullback. Now the question is, which direction will it go, right? If there's some fears hitting the market, right? Right now, we see the US dollar has been strengthening today, pulling gold down, then it might be deemed opportunistic to sell on oil from a high point. So if I look at the 15-minute candles, I say, wow, this is a nice resistance level, resistance down, resistance down, resistance. Maybe I sell on oil. Okay. Why did I sell on oil from a technical analysis standpoint? Because we've got resistance and dropping started. We've got resistance here where it fell down, and we've got resistance here where it fell down. So technically speaking, we're at a resistance point. And now that I sold, I can put my stop loss right here, very limited risk. I'm above the resistance, just a short distance away. So it was an opportunistic spot to sell from, because technically speaking, I'm below the resistance. And unless the fundamental news changes, oil should pull back down, right? Especially if the USD has been bullish today, which it has been. So then we say we could be wrong. We put our stop loss here. Our take profit, if it comes near the low that it already hit just an hour ago, then or a few hours ago, I should say, early this morning, then my potential profit is about 3 times what I'm risking. About 3 times potential profit compared to risk. So this could be an interesting setup then. All right. Dom, I don't know what you mean by rejection. What are you talking about? You'll have to expand. But we see resistance point here. We see confirmation. It's bouncing down off the resistance. And we have a fundamental reason why oil has been bearish. Bearish means pressure pushing it down. And it was largely due to Iran's stated policy or maybe unstated policy. And then also some fears about COVID leaking back in. The distribution of vaccines seems to be not going fast enough for some analysts' likings. And so there's some fear about COVID returning that's strengthening the USD and putting bearish pressure on commodities and the equities. Okay, and we're off to a good start. We've got 2 out of 3 trades winning. We knew that first one of them would probably lose, right? So now we know the gold lost that fight. Gold's still trying to drop with the strengthening USD. And we probably could have assumed that if we only wanted to pick 1 out of 2 of those trades, would we take gold as a buy when USD's been strengthening, or euro as a sell? And probably euro as a sell made more sense, right? Declan, I don't know about that. You'd have to check maybe on our main website or something. It's possible that that could be a potential opportunity. Okay, so we've got 2 out of 3 running, and we'll see what happens. We had limited risk on gold. We got out. Boom. Now we know which one was the leader. It seems gold was leading, and now here comes Euro USD potentially to follow with a much larger potential profit than what we risked on the setup with both gold and euro. And again, the fundamentals might have told you you probably should have went with Euro USD as the sell rather than gold USD as the buy, simply because there's been some fear hitting the markets today, strengthening the USD. Okay, so another interesting thing to look at here, if we look at the Ftse, we see it's down today, right? 15-minute candles down. We look at the US 30, down today. We look at the Tech 100, down today, right? They're all down. There's bearish pressure, which is why we should have expected maybe Euro USD to be the winner out of those 2 that we set up. So why is the DAX 30 up? Overall, it's up today. So if there's bearish pressure and everything seems to be falling today, we find one that sticks out that it's up, and it's because out of Germany, the car sector did really well. It spiked the DAX 30 up, but it's the outlier. Everything else is dropping. So since this is at an all-time high, look at the 1-week candles. It's an all-time high for ever being that high. So if you're going to short one of these indices thinking that there could be a sell-off maybe coming a little bit on the markets, then technically speaking, the DAX could be an opportunity because it spiked up today when everything else was dropping. So you have a much better entry point on the DAX if you feel that it will drop. Okay, that's if. So this setup then gives us a very little risk to get above the all-time high, which was hit today. So I'm on 1-hour candles here. I'm above the all-time high. If it breaks to another all-time high, then I get out with small risk. If there is a sell-off coming, then the first support level's down here. Okay, there's my take profit then. My take profit is just above this old resistance, which now should be support. So resistance, resistance, resistance here, resistance here. It broke through that resistance earlier today with the auto industry numbers, and up it went. And now the reversal after reaching an all-time high. Why is it reversing? Well, the whole market seems to be dropping today. Okay, so other than the USD, which is strengthening as a safe haven currency a lot of times, along with the yen, during times of maybe some fear building up. So this is a really nice opportunistic setup to sell from an all-time high in a dropping market. Okay, so we've got stop loss above the all-time high with little risk, and potential profit much greater. Even getting out before the first support level, we've got a potential profit about 3 times what we're risking. So that's a nice setup, technically speaking, and then fundamentally sound as well. And look at all 3 of our trades now off and running. So, okay, we lost 19 on gold. We're up 25 already on the winners, right? So if you're a scalper, you could already close. Take your small profit, in and out, in and out, in and out. Proper technical entry point, backed up by fundamentals. And by the way, No indicator will do this for you. You have to use your brain. You have to look at the fundamentals and say, okay, what's my direction of preference? And then boom, you're in. And we easily could have avoided the loss on gold, because in that strategy where we're saying one of them's going to follow the other, we could have used our brains and said, well, probably the euro dropping would make more sense to follow gold down rather than gold following the euro up, because USD's been strong all day. Okay, so the outlier in that example was the euro being up. Everything else was down. So it was easy to pick the outlier and maybe avoid even bothering to go with that buy on gold for that scalp move. Okay, and so and if you're scalping, then you're already in a nice profit. You've made 30 something and lost 19. So boom, you can close, close, close. And if you're taking a larger type trade size, you're already walking with your profit for the day, right? Declan, it's great if you're getting into full-time trading and you're studying, taking it professionally. I'm not sure who your account manager is, maybe me, but if you need some help, just let our support department know, or your account manager, okay? All right, great. So we see what's happening here. Let's look at the Euro GBP, okay? And see what's happening there. It's really interesting with the announcements that are going on today, and the bank information coming out, monetary policy out of both the European Union and Great Britain. This pairing could be really, really volatile today. And you see, look at the big drop and now the big spike up on the 1 hour candles. Let's look 5 minute. Look at this huge swing, these huge swings you're seeing. This is great for technical trading. You're going to have what we call great price action with this combination because of the central bank in both countries with big information coming out. So you can easily say, okay, resistance level, sell, right? You can say resistance level, sell. Stop loss here, take profit at the first support level here, and just wait for your movement, right? Wait for the movement to go. And you quickly could see some easy scalp profits with this type of price action without having to wait very long and with little risk, because there's so much movement up and down. You can wait until you get to the resistance level or the support level you prefer to sell or buy from, and then quickly close with your profit at a level that is acceptable to you. Whether you're looking for 0.5% gain on your account or 0.25% gain per scalp move, it's something that can be easily done in a short period of time with this type of price action. Okay, so this is something with the announcements going on right this moment that you get unique bounces, rapid movements up and down, up and down. And so it's something you can take a shot at with this type of strategy quite easily on pairings that have fundamental news driving the technical bounces, breakthroughs, and movements. Now we could also look at Euro USD. Okay, USD is strong today, right? So it's an easy move to say if the euro is at a resistance level against the USD, sell. If it's on a support level, maybe avoid it, right? Avoid buying from the support because you trust it less if the USD is bullish today. If there's reason fundamentally for USD to be strong, then maybe you avoid buying from the support levels, but look how nicely it's dropping from the resistance level. With the USD being strong today, you trust the resistance level more maybe, okay? So just some ideas with setups of how you can manage trades. And it's up to you when you get out of the trade, right? You might see profit at a certain mark and say, okay, that one I like, and boom, I get out, right? Maybe I take my crude oil profit. Maybe I'm still waiting on my Euro USD for a nicer profit level. Okay, and you could see I could have stood to take a larger trade on the Euro USD because with gold, I lost 20 on a short distance to the stop loss. With the Euro, almost all the way to my take profit, I'm still not making as much as I lost on the shorter movement on gold. So I should have probably taken a trade of 0.05 or 0.03 on gold instead of 0.1, right? So that the stop loss distance for each was less risk than the potential profit of the other, right? That's the proper way to set that up. But because for time's sake, I was just putting the same trade size for everything, but you want to quickly calculate that so that right now we'd be an overall profit on that gold euro combination trade setup because we got a much larger movement towards our take profit than we lost on the small movement to our stop loss on gold. So that's just to keep that in mind so that you give yourself a larger potential profit in that setup compared to risk. But still, overall, we're in overall profit. If I wanted to close everything off, I could say, okay, I collected, and now our last trade, that scalp is moving into profit. Okay, so we've already collected more profit than we've lost with each of these trades. Okay, and it's just simple scalping strategies that we look at where we say, okay, we lost 20, but we made 15, 10, and broke even on that one. So we lost 20, we made 25, right? Now that's a microcosm view. We could have let these carry out further, but we need to end the webinar, right? So we're about out of time, but you can see that the majority of our moves went the right way, at least in the short term for scalping purposes and likely for longer term moves by aligning the fundamentals with the technical analysis. Dom, you can manage your trade by sliding your stop loss anytime you want. Once you see a profit that you'd like to preserve, you also could put a trailing stop on your open trades. Okay. The key is knowing before you go into the trade, what amount of profit am I happy with? What do I want as a potential profit, etc. And then all of those questions are answered for you before you even open them. So that way you know when I get the certain amount, I'm going to slide my stop loss to break even or to 50% of my profit, or I'm going to do a partial close on my trade rather than closing the whole thing. You have each of those options, have that plan worked out before you start. Okay, good question. All right, everybody, I think this is a good place to stop for the time being. And I'll be doing another webinar then Tuesday next week at 6 p.m. GMT time. All right, everybody, good luck with your trading through the day today. I think you'll see some great movements like we've already seen, bouncing and moving off of the support and resistance levels with a preference towards breaking supports and respecting resistance a bit more today with the USD pulling other pairings down so far today. All right, everybody, thank you. Have a great rest of the week and weekend, and good luck with your trading.